and thank you all very much for joining us today for a briefing on climate risk and response. Tomorrow is Earth Day, so it's an auspicious time to be having this conversation. And as you may know, the McKinsey Global Institute earlier this year published a report on the subject that looked at both the physical hazards and the socioeconomic impacts of physical climate risk. Here to discuss the issue are two of the key authors of that report. They are Hauke Engel, who is a partner in McKinsey's sustainability practice in Frankfurt, Germany, and Mikela Krishnan, who is a senior fellow at the McKinsey Global Institute based in Boston. MGI, as you may know, is the research arm of McKinsey. My name is Peter Gumble, and I'm MGI's editorial director. I would just like to hand over to Hauke, who will be taking us through the first part. Thank you, Hauke.
Thanks very much, and thank you all for joining us today. Before we get started into the content, let me just say a few words about the current context, right? So of course, the COVID crisis is top of mind for everyone. And we actually think this is also an apposite time to talk about climate risk, both because the frailties and vulnerabilities of our global economic system that are unveiled to some extent by the current crisis, also the same ones that might be hit by physical climate risk, as we'll explore in this presentation, and also because the eventual response to the crisis and the recovery from crisis may also be a pivotal time to address or not address the climate crisis. I think there's some similarities, but also some dissimilarities between the crisis and some interdependencies in how and when we address them. So with that upfront remark, let me go into the content here. So the overarching frame of the research we did was really to look at physical climate risk. So the underlying physical phenomenon is climate change. So the fact that due to human emissions of greenhouse gases, which have greatly risen since the start of the Industrial Revolution a few hundred years ago, we've seen a warming of the average surface temperature of the Earth, as we see on this page here. So the warming has been uneven. The Arctic, for example, has warmed much more than, for example, parts of Southern Africa or Latin America. But overall, we've seen a quite significant increase in average temperatures. And then those rising temperatures are then also causing a whole host of other physical phenomena in the Earth system, such as more intense tropical storms, changes in precipitation patterns, droughts, etc., etc. And what we wanted to look at here, and what we have looked at, is then how those physical phenomena translate into socioeconomic impacts and what we might want or can do about them. So I think a few conceptual ideas to ground us and get us started when we talk about climate risk. So the climate is fundamentally predictable in the sense that it is a statistical trend. So weather, of course, as we know, is very hard to predict more than a few days out in advance, but the statistical trends in weather patterns, which is what we call the climate, is actually predictable in a probabilistic sense. So this is a very important concept, that this is really a game of probabilities, of probability distributions. So when we look at a climate variable, such as summer days, temperature of summer days, that we look at here on this chart, this is really a matter of a probability distribution. And this is quite nicely illustrated here when we look at this page. We see here the distribution of summer temperatures historically, which is the white chart. And you see that it's a nice classic Gaussian distribution. And we have an average summer temperature that is marks the peak of the distribution, but then we also have the likelihood of warmer or colder days occurring that you see from the tail of the distribution. When we look at the observed distribution historically, and then the more current distribution, which is the blue line, we can see that has shifted. So it's moved to the right towards warmer temperatures, and that's basically the effect of climate change, of global warming, that we see an increase both in the average temperature, so the expected median value, but also as a consequence of that, we have see a shift in the tail. So the likelihood of extremely warm States has increased quite substantially. And it's this feature of probability distributions that's also quite important to keep in mind. When we talk about climate risk, it's that the extremes are also shifting quite substantially. The averages are shifting, but also the extremes, the tails are shifting. And a lot of the risk that we're exposed to, or that we will be exposed to, is driven by the tail events, and that's always very important to bear in mind. Now, just to illustrate what is expected to happen. So for this research, we looked at a scenario of continued high emissions. So we tried to perceive a scenario of no climate action, where we don't take strong action to reduce emissions, but we see continued use of fossil fuels and an increase in atmospheric greenhouse gas concentration. And the reason we chose that scenario was because we wanted to get a measure of the inherent risk. So we wanted to look at what happens if we do not take action to rein in warming and manage the build-up of risk. So all the numbers and charts you'll see in the following hour are looking at this no further climate action scenario, the inherent risk scenario. So to illustrate the shift in the averages, right? So this is a chart that shows that the current expected percentage of a decade that is spent in drought by region. So you see it's already a bit of an uneven distribution. The Mediterranean is seeing drought a little bit more often than other parts of the world. And if you wind the clock forward, you can see that if you go now to 2030, you see the more red patches appearing. The expected average share of a percentage of a decade spent in drought is increasing. And if you wind further forward, towards 2050, that is increasing even further. So this is a good illustration of kind of the average expected change in a hazard. Then we can also look at an illustration of a tail event. So here we see a map of the Southeast United States and of Southeast Asia, which maps the expected likelihood of a hurricane of a certain strength, what used to be a so-called 100-year hurricane. So a hurricane that was in the past expected to happen on average once every 100 years. And here we look at the expected change in probability of such a hurricane happening. And as you can see here, by 2040, in many parts of the Southeast United States and Southeast Asia, the likelihood of such a hurricane occurring is doubling or even tripling in some places. So this is an illustration of an extreme event, a tail event, so to say, that sees a significant change in probability, in expected probability. Now, these are the changes that we expect to happen in the physical environment. Now, what we wanted to look at, as I said in the beginning, was really then the socioeconomic impacts of this. So the scope that we set ourselves was to say, okay, taking the expected changes in the Earth system that climate scientists tell us about, what does this actually mean for business and society? And this is what's called the physical climate risk. And just to differentiate, what people also often consider is what's called transition climate risk, which is the risks caused, or the potential changes, impacts caused by society's efforts to reduce emissions, so shifts in policy, changes in technology, etc. This is not what we looked at here. This is squarely about the physical risks, so the impacts caused directly by the changes in the physical environment. And before we go further, we just want to ground us and take a quick call from the participants.
Yes, so we would like to ask you a question. And the question is, how important do you think physical climate risk will be for your organization over the next decade? And the answers are either A, not at all, B, somewhat important, C, quite important, or D, extremely important. And if you can go to your screen, you should see those answers coming up. And if you could just click on one, and we'll be interested to see where we come out on this. So we'll give you a few seconds to do that. Click on one of the answers. And in the meantime, we have a question that's come in, which is for Hauke, that we've had previous periods of global warming. So the question is, what is really different this time? And what is the issue with the carbon output? How much is that affecting really what's going on?
Mm-hmm. Yeah, thank you. I think that's a really good question to tide us over or wait for the results to come in. So the climate is, of course, not a constant, right? The climate has always in the past been changing, and it's actually in the far distant history, it's actually changed quite dramatically. We've had ice ages, we've had hot periods, but since about 10,000 years, we've lived in a period of relative climate stability, the so-called Holocene, which is actually what many archaeologists, historians say is actually was the precondition for civilizations to arise. Yeah? So this climate stability, this relative climate stability was what enabled us to settle down, to move from a hunter-gatherer lifestyle to become farmers, to accumulate surpluses, to build cities, to specialize, to build up civilization. But even within this period of relative stability, we have had climate patterns. Yeah? We've had a medieval warm period, medieval cold period. In other parts of the world, there have been changes in long-term climate patterns. I think what's different about the current effects is the scale and speed of the changes. So both the magnitude of warming and the speed at which they're occurring is really quite unprecedented. And it is, by the way, beyond doubt caused by human emissions of greenhouse gases. So it's we are causing this change, and it is something that is really unprecedented in human history. As we'll explore in this presentation, it might have some fairly non-optimal consequences in the socioeconomic domain. And I think we have the poll results.
Yes, we have the poll results coming in. Very interesting. So not at all, only 1%, somewhat important, 18%, quite important, 43%, and extremely important, 31%. So 3/4 of you clearly think that this is an important issue. Is that surprising, Hauke?
I think it's encouraging, right? I think it's quite consistent with what we've seen in similar polls that we've taken. And it's actually, it's not surprising, but I think it's encouraging, because I think that with some people that we've spoken to in the past, there's kind of sometimes an insufficient awareness that besides the fact that climate change is happening, that it also can have quite material consequences for their own organizations. So it's good to see that with this audience, we can take that as a good starting point and explore how specifically climate change might impact various socioeconomic domains.
Yeah, and maybe, Hauke, I can just add one point there. I think as we framed the question, we also put in the phrase over the next decade. And I think that's also quite telling in your response, is that many of you feel like it is significant over the next decade. One of the explicit design choices we made as we did the work was to not look at this as a second half of the century issue, but really try and understand impacts over the next 10 years and over the next 30 years, because we wanted to try and understand impacts in the decision-making horizon of companies and organizations today. So I'm also struck that you responded to this question as quite important and extremely important with that next decade framing, which is exactly the time frame that we're going to be exploring as we go through the rest of the slides.
Thank you. Indeed. So one concept that we almost stumbled upon quite early on, right, is this idea of what's actually at risk here. And typically in research to date, the usual metric of impact has been economic activity, so GDP most commonly. What we found is actually that even more important than economic activity is really that it's the foundation for economic activity, that the capital stock that's being impacted by climate risk. So it's really the foundation upon which our well-being and wealth is built that is being impacted. And we clustered these into 5 different social systems that are being impacted by the physical effects of climate change. So one is we have livability and workability, so the ability or the suitability of a region that people can live and work there, which directly impacts human capital. And we have physical assets like buildings, factories that are being impacted, that are being damaged, and infrastructure services, the provision of electricity, of water, of telecom services, so which is the physical capital of our world that's being impacted. And finally, we have natural capital. So we have food systems, fisheries and agricultural systems, and finally nature's capital, things like glaciers, and forests that provide important services for societies and businesses. So it's really this idea of it's the capital stock that is being impacted. It's the source of our wealth, not just our cash flow, so to say, in economic terms. So the way we approach this work is that we wanted to really go deep and understand in full detail and in the full extent of how the physical hazards that intensify and due to climate change impact social systems. So we took a case study-based approach. So we looked for a set of case studies, 9 in total, that sampled fairly comprehensively different hazards, different regions, and different socioeconomic systems impacted. And for each of those really went deep and tried to understand in full detail how climate change impacts those and what the first, second, or third order effects look like. So this has been the foundation of the insights that we're going to share over the next half hour. And by the way, the detailed case studies we're now starting to publish over the coming weeks. So we published the main report in Davos earlier this year, and now over the coming weeks we're also releasing kind of the backup material, so to say, to our detailed case studies. And I think the first one was published yesterday, looking at flooding impacts on Ho Chi Minh and Bristol. So with that, let's have a look at some of the results. So if you look at the top level findings, so we looked at today's risk levels and then 2030 and 2050 as kind of 2 points in time that are meaningful for decision makers and policymakers today. The interesting aside, by the way, is that under business as usual or a no climate action scenario by 2030, we expect a roughly 1.5 degree of warming to occur, which is the aggressive goal set, or the optimistic goal set by the Paris Agreement to limit global warming. And by 2050, we expect a roughly 2 degrees of warming to occur, which is then the kind of the minimum goal, right? That's set out in the Paris Agreement. So another way to look at the results that we're going to share today is that if we hit the less ambitious goal laid out in the Paris Agreement, the worst impacts we'll see are the ones that we see here as named under 2050, but at a later time. And if we achieve the more ambitious goal set out in the Paris Accords, the worst impacts we'll see are those we lay out here as 2030 numbers, but of course again in a later point in time. But going back to our findings here, so what we see is that across the 5 socioeconomic systems, by 2030 already we expect a significant increase in expected damages and risk compared to today. So for example, in livability, workability, we expect roughly 250 to 360 million people will live in areas that have a non-zero probability of a lethal heat wave occurring, a heat wave wherein it's so hot and so humid that even a healthy adult, well-hydrated, resting in the shade would suffer a lethal heat stroke after a couple of hours of being outside. It would literally be too hot for healthy humans to survive outside, which currently doesn't happen anywhere in the world. But by 2030 is expected to be possible to occur in regions where we expect 250 million people to live. And likewise, in food systems, we expect a doubling of the probability of a significant global food production shortfall. We see an expected doubling of significant flood risk to occur to major capital stocks. And finally, we expect that roughly 30% of the Earth's surface will experience what's called a biome shift. So a biome is the envelope of plants and animal life that is supported by a certain climate, and the local climate shifting away so that the current biome can no longer be supported by the climate. It's called a biome shift. And by 2030, roughly 30% of the Earth's surface could experience such a biome shift. So that's 2030, already quite a significant increase in risk levels compared to today. And then by 2050, those numbers increase even further. We see up to 1 billion people possibly living in regions that could expect a lethal heat wave, and a quadrupling of possible food production shortfalls, a quadrupling of flood risk, and 45% of the Earth's surface, roughly almost half the Earth's surface, could experience a biome shift. So a sustained increase in risk to 2030 and to 2050. What's behind this, and this is one of the, for me, actually most interesting findings from the work, is what we call the non-linearity of climate risk. So the hazards, the changes in expected intensity or frequency of hazards such as floods, heat, extreme rain, etc., usually increase gradually over time. But what we found is that then the social impacts caused by those hazards often at some point start to increase quite dramatically non-linearly. And that is essentially because our systems have been designed or have evolved to function optimally within historical climate boundaries, within historical climates. And that as soon as we go outside those safe operating zones of the past climate, we see almost like a breakdown of certain systems. I think with the human body, it's quite obvious. Once we become too hot, internal temperature rises above a certain threshold, we suffer heat strokes and eventually die. We also see this, for example, in food systems. What we see here on the chart in the middle is the growth rate as a function of temperature of corn, of maize. And you see that it's really optimized for quite narrow temperature bands, centered on 20 degrees centigrade. And as soon as we move towards colder or hotter temperatures, the productivity, the growth rate drops quite dramatically. And similarly, on the right-hand side, if we look at the impact of flooding on a human-made asset, I think a train station we looked at here, you see that low flood levels are typically quite well absorbed, but then at some point thresholds are breached and we see a quite significant increase in damage cost. So this non-linearity of damages that illustrates and characterizes physical climate risk. And Mika, I want to hand over to you to talk us through some examples of our case studies.
Yeah, just before you hand over, Hauke, there's one question that came in, which is, how can we expect and measure the degree of climate risk in the coming years?
Yeah, so the methodology that we used is that we took the climate science, so the forecasts of expected changes in the Earth environment that climate scientists are able to make based on basic science, basic physics, and the models. And then we basically look at what's in harm's way, right? So what is exposed to those hazards, and then we draw on historical correlations of hazards causing damage, what's called a damage function, or engineering estimates or other ways to translate hazards into damages, to estimate the expected damages or the first order impacts caused by those hazards. And then of course, yeah, you can kind of wind the clock forward with that. You can look further out in time and then see how hazards are expected to change in the future and how the exposure, so the asset base that is could be in harm's way changes to come up with an estimated damage. And then, of course, there are second-order effects. So the immediate damages, the physical damages to houses or buildings, say, can also translate then into second and third-order effects as we see market reactions, as we see people reacting to this, et cetera, et cetera. So that's fundamentally the approach we took, taking the science as an input and then looking at how the exposed assets would be impacted by this.
Yeah, and maybe just to add to that point, I think this is this approach which we in the McKinsey Global Institute typically refer to as a micro-to-macro was, I think, quite a distinguishing feature of this research, right? Because a lot of the other ways people have thought to assess climate risk has looked either top-down, looked at historical relationships between broad climate parameters and things like GDP growth. But in our case, what we did was really explore this problem bottom-up to understand the design thresholds of a set of physical systems, such as the examples that Hauke is showing on this slide here, or on the other hand, economic or financial social systems. And it's really through understanding these design thresholds, what these systems have either evolved or been designed to tolerate, that allows us to understand the magnitude of impact, because there are non-linearities of the system. So assuming that traditional historical relationships hold going forward may no longer be true in how we're expecting to see the climate evolve. Okay, great. So Hauke, if we move to the next slide, then what we wanted to do next is give you a little bit of a tour of some of the case studies that we explored in the research. As Hauke had mentioned, we did 9 different case studies covering different sectors, assets, geographies. We don't have time to go through all 9 of them, but we wanted to give you the highlights of a few that we thought would be particularly interesting to this audience. The first one here that we put up is looking at the question of heat and humidity in India. So India is a country where already temperatures are quite high and conditions are quite humid. It's also an economy that relies significantly on outdoor work. About 50% of GDP, 75% of economic activity in some way, shape, or form relies on outdoor labor, whether that's in agriculture or construction. And what we find through climate science is that going forward, conditions of heat and humidity could only increase in India. And that has 2 effects that we explored. The first, which we see on this top panel here, is to understand how outdoor working hours and labor productivity could be affected as heat and humidity conditions rise. So as you get hotter or more humid conditions, the human body starts to function less optimally outdoors. We start to fatigue more, we need to take more breaks, and that has implications for how productively workers can perform their outdoor tasks. And we find, winding the clock forward, if we look at the rise in these heat and humidity conditions, as much as 2.5 to 4.5% of GDP in India could be at risk by 2030. Now, if you take a step back and think about traditional economic and financial models, all of them are assuming today 7%, 8% growth for India. But what this analysis calls into question is the very foundation of that growth. Will we be able to grow labor productivity, grow economic activity in conditions where heat and humidity rise to the level that we're describing here? The second thing we looked at is the prevalence of lethal heat waves, and Hauke talked about this a little bit as regards to global numbers, but we found that some of the regions that are most affected by lethal heat waves are in South Asia. If you look at the numbers for India, by 2050, as many as 310 to 480 million people could live in regions that have an annual 14% chance of a lethal heat wave. Now, 14% may seem like a relatively small number, but when you think about it, what that means is that over the course of a decade, that 14% annual likelihood almost guarantees you 1 lethal heat wave over the course of 10 years. And so these are heat waves that nowhere on the earth we've ever experienced before, heat waves that impact healthy human beings sitting in the shade. And so again, is a deep challenge that India will need to deal with, but also calls into question the very assumptions that we are putting in place as regards to global growth and how companies across the world are making business allocation decisions today. If you move to the next slide, as another example, we looked at food systems. We've essentially organized production in the world, whether it's food systems or supply chains more broadly, so that these systems have been optimized for efficiency, not optimized for resiliency. What that means for food production is that we get the majority of our grain production, about 60% of global grain production, from 5 regional bread baskets, and that's also from where we get the majority of our calorific intake. It comes from 4 grains: rice, corn, wheat, and soy, and these grains are largely grown in these 5 bread baskets that we show on this slide. What that means, though, is that with the changing climate, if these bread basket regions are exposed to climate risk, that could pose fundamental food security at risk. And that's what we see could happen in a world without adaptation and mitigation action. If you pivot to the next slide, Hauke, what we see on this chart is the likelihood of global grain yield declines of different magnitudes. We looked at what the probabilities of a 5%, 10%, and 15% yield decline could be across the different rows here. And we look at that today in the darkest blue all the way out to 2050 in the white. And what we see is that across these different magnitudes of yield decline, whether that's 5%, 10%, or 15%, across the board we see an increase in the likelihood of these yield declines over time. If you look at the bottommost row of this chart, for example, the 15%, greater than 15% yield decline, what we find is that today we have about a 1% annual likelihood of that yield decline. What that means is that in a decade we will see at least a 10% likelihood of that magnitude of yield decline. But then fast forward to 2050 in the white, what we find is that in a decade, in a 10-year period, we have at least a 34% chance of experiencing grain declines of this magnitude. And if you pause and think about it, right, one immediate reaction is to say this means that we will face food shortages around the world. The good news is that that's not likely to occur. We've actually built up food storage levels that allow us to have buffer stock in the case of such events occurring. But what it does mean is that as we start to draw down on food storage levels, we're going to see increases in food prices. And that could have fundamental implications for people that are below the poverty line, where a significant portion of their spend goes towards food. It could raise food prices to the level where this starts to become a real challenge for vulnerable populations across the world. I think this thought of efficiency versus resiliency, hold on to that. We'll come back to that in another case when we talk about supply chains and the impact that climate change could have on supply chains. If we move to the next slide, Hauka, before that, let's look at the impact on physical assets. So as Hauka was saying, what we found from the work is that climate risk could fundamentally impact the factors of production. It could impact labor productivity, like the case study we saw for India. It could impact natural systems, like the case study I just talked about with agriculture. But it could also impact real estate. And we show that example here with Florida. When you think about climate risk, the immediate picture that comes to people's minds is a flood or a hurricane and how that could damage property and infrastructure around the world. And that's indeed true. What we find is that in Florida, as sea levels rise, we could see increased risk of storm surge as well as tidal flooding that could damage properties in the Florida region. But perhaps more worrying for the state of Florida is the impact that it could have on home prices. So in some ways, damages to real estate are things that we can insure against, we can protect against. But what may be an unrecognized risk for real estate is actually the impact we could see on price devaluations, which could happen in advance of these events occurring. It could also happen in a way that is difficult to insure or protect against. So what do I mean by that? We looked at residential real estate in Florida and how homes exposed to tidal flooding today, what prices those homes are seeing relative to unexposed properties. So like for like, what are home prices in areas that are exposed to tidal flooding compared to areas that are unexposed to tidal flooding? And what we find is that today there's already a spread between the two. The spread between the two means that homes that are exposed to tidal flood risk are devalued to the order of $5 billion. That's that first row on the chart on the left, first column on the chart on the left, excuse me. So already we're seeing a $5 billion devaluation in Florida real estate just because of prevalence of tidal flooding. And if you fast forward to 2050, what we're going to see is more frequent as well as more severe tidal flooding, such that we could see $30 to $80 billion of devaluation as a result of increased flood risk. What that translates to for these impacted homes is a 15 to 35% devaluation of the homes. But it doesn't just stop there. This is almost, I would say, a conservative estimate because it's looking at the relationship we're seeing today, how much homeowners are pricing in this kind of flood risk today. But if you fast forward to 2050, what we could see is either more aggressive pricing in of flood risk as homeowners don't want to bear this form of nuisance flooding. We could also see more significant effects as entire communities are affected. So if a significant number of homes in a particular community are affected. And furthermore, we could see even more significant effects if you start to see impacts on the availability of insurance, if you start to see impacts on infrastructure in different counties, so on and so forth. So it's important to recognize that when we think about the impacts of climate change, it's not just the immediate damages, immediate impacts on productivity, but it's also important to recognize that financial markets can play a role in pulling forward that risk in the form of asset price devaluations, capital reallocation, impact on insurance costs and availability. If you move to the next slide, Hauka. I think we wanted to put this slide on to also illustrate another aspect of climate risk, which is that the linkages of climate hazards to impacts on economic, financial, and social systems can be extremely complex and have a multitude of knock-on effects. So in the Florida case, for example, we talked about the impact on home prices and devaluation, but it may not stop there. We could see second and third order effects as a result of that. One kind of second order effect, as I described already, is that if multiple properties are damaged or multiple properties are affected by devaluations, we could start to see significant nonlinearities and a vicious cycle where we start to see price effects. Furthermore, if you think about the state of Florida, it's a state where a significant portion of GDP, about 25% of GDP, relies on real estate. A significant portion of government tax revenue relies on property taxes. A significant portion of homeowner wealth is tied to real estate. And all of that means that you could start to see effects like loss of state revenue due to property devaluations. You could start to see impacts on new developments in the region, and further set forth impacts on home prices as a result of that. So all to say that the impacts that climate change could have on our physical systems, certainly, but also our economic, financial, and social systems are extremely complex, and we could see cascading knock-on nonlinear effects. And in this way, this form of risk is actually similar to what we're experiencing with COVID today, with a multitude of knock-on unforeseen impacts happening as a result of that immediate shock in the case of COVID, the pandemic shock in the case of climate, of multitude of climate events. So that brings me to the next slide, which talks about supply chains. So one of the things we wanted to explore with our study was to say how much could supply chains be at risk as a result of climate events. Again, we've organized global production, so it's concentrated in a few specialized geographies. And that's, of course, led to efficiency gains, led to productivity gains for supply chains and companies across the world. But it's also created a form of vulnerability. If the impacted regions are affected by climate disasters, whether that's hurricanes or floods or droughts, what that could mean is that there are a range of cascading knock-on effects to downstream players in a supply chain. If a downstream company, for example, does not hold sufficient safety stock levels, if the downstream company, for example, is not able to ramp up production in a different location, if the downstream company is not able to switch suppliers easily, all of that could mean that it's not just the directly affected supplier that's affected, but the entire supply chain that is at risk as a result of a climate shock. And we show that illustration here for a semiconductor supply chain. So we looked at how much could a 100-year hurricane disrupt a semiconductor supply chain. So if an upstream chip manufacturer is affected, what could be the impact on downstream electronics players? And this is an illustrative example, but using a set of assumptions, we compared what we call an unprepared player with what we call a well-prepared player. So an unprepared player may be one that only has single source supply, has limited resilience of their upstream suppliers, has limited safety stock. On the other hand, a well-prepared player may be able to source from multiple suppliers, may have worked with their suppliers to build up resilience of their facilities, may have appropriate safety stock buffers. And we find that the impact on revenues could look very, very different for these two different types of downstream electronics players. The unprepared player could see as much as 35% of their revenues impacted compared to the well-prepared player that is able to protect themselves appropriately and could only see 5% impact on revenue. So all this to say, looking at all of our numbers and the magnitude of impacts we described, this may lead you to think this is a huge potential issue and take away a sense of alarm from the work. That was absolutely not our intention. I think this slide illustrates clearly that if we understand and recognize these risks and put in place measures to manage them, and there are a set of measures to manage them, we can protect ourselves against the impacts. So hold on to that thought. We'll come back to that when we talk a little bit more about what organizations can do about this. If you move to the next slide, Hauke. The last point just on the analysis before we pivot to what organizations can do is an important characteristic of climate risk that we're also seeing echoed to some extent in the COVID experience we're all living today, which is that this is a form of risk that is regressive. The most vulnerable populations across the world, whether it's poorer countries, poorer geographies, could see higher impacts from climate change. And that's for a few different reasons. The first is that many times these countries or regions tend to be at the climatic thresholds that we described. They tend to already have extreme climates, so that small increases in climate change could cause significant nonlinear impacts. And you see that example here for a particular metric that's looking at how much working hours could be affected by rising heat and humidity. This is the same measure that I talked about for India. And on the y-axis here, we show how much of working hours could be affected as a result of rising heat and humidity. On the x-axis is the GDP per capita, the level of development of countries. And in general, you see this downward trend, right? It goes from the top left to the bottom right, which means that the most impacted countries, those on the top left, are also the ones with the lowest GDP per capita today. So the reason climate risk is regressive is, number one, countries and regions that have the lowest development levels often tend to be at climatic thresholds. Reason number two is that oftentimes people in these countries tend to rely more on outdoor work. They work in sectors like agriculture or construction. They rely more on the natural environment. For example, they work in fisheries. And so all of that puts them more at risk as the natural environment itself changes. And then finally, of course, it makes adaptation more challenging. While our research identifies a set of measures you can put in place to adapt, and those measures exist across sectors, across assets, across geographies, they do come with a cost, and oftentimes adapting may be harder for the poorer countries and regions of the world. So with that, we wanted to tee up another poll question on the next slide. Peter, did you want to walk us through this?
Yes, so the next poll question is about your organization and how well has your organization assessed its exposure to physical climate risk. And there are three possible answers: A, not at all; B, somewhat, in other words, a qualitative assessment; and C, that you've done rigorous assessments. So we'll be interested if you could click on A, B, or C, which should be coming up on your screens, and we'll see whether that also reflects the concern you expressed earlier on about the importance of climate risk. In the meantime, while you're doing that, we have time for one more question, perhaps, which is there's been a lot of questioning that have been coming in around sort of the COVID and the climate intersection. Mikela, you briefly mentioned that, but I'm wondering if you could perhaps talk a bit more about where do you see that, and perhaps one of the questions was, is there a positive knock-on effect from COVID that it's made people perhaps more aware of the risks from climate?
Yeah, absolutely, and we'll talk a little bit more about this in a few slides from now. But there are similarities with COVID, as I've outlined before, and I think there is the opportunity certainly to use the recovery that we are going to be undertaking post-COVID to also enhance climate action. I think there are certainly tailwinds that could mean that we see accelerated climate action, but there could also be some headwinds that need to be managed towards climate action. And the question is, how do we create appropriate synergies between the COVID response and climate action? But I'll talk a little bit more about that in a couple of slides from now. So in the meantime, we have the results of the poll. So we see that most of you, about 50%, say that your organization has somewhat, that is, qualitatively assessed its exposure to physical climate risk. And about 16% of you say your organization has done rigorous assessment. So that 16% is great to see. That's actually higher than what we've seen most times when we've done this poll. I think the 50% of somewhat, some kind of climate assessment is fairly typical. And I always find it interesting to contrast this question with the earlier question that we asked, where about 75% of you said that you would expect to see relatively significant damages from climate risk. And I think that's very consistent with what we are hearing as we talk to organizations about this issue. I think a growing recognition that this is an issue that is important in the next decade and beyond. But I think companies still on the path to beginning the journey to do risk assessments and think about an appropriate response. So what does that mean? What is an appropriate response? If we move to the next slide, our work essentially points to three different areas for companies to focus on, companies as well as countries to focus on. The first is embedding an understanding of climate risk into all decision making. As we've now hopefully hammered in through our remarks, assumptions of a stable climate are built into every aspect of our lives, whether that's physical systems, economic systems, financial systems, or social systems. And so it's important to undertake a process to both qualitatively and quantitatively understand the risk, and then embed an understanding of how to manage the risk into each and every process. What that means, for example, for a city is integrating climate risk into their urban planning decisions, into their infrastructure design decisions. For a company, it may mean integrating climate risk into their capital allocation decisions, into their supplier decisions, into their financial market forecasts, so on and so forth. So that's every action that a company or a country or a city undertakes, it's important to look at with a climate lens, because every aspect of their business or their operations is going to be affected by climate. The second thing is adapting to climate risk, and we identify a range of measures that one could undertake to adapt. It could be everything from hardening physical assets to building resiliency through diversifying suppliers, raising inventory levels. But it's also, in many instances, reducing your exposure to the risk. And that may mean relocating people from at-risk regions, relocating facilities from at-risk locations, etc. To me, I think there is a good toolkit that exists on adaptation. And happy to have further conversations with any of you that are interested later on about that topic. But I think the thought I want to leave you with on adaptation is the harder question almost on adaptation is not so much the what, but the how. I think adaptation is going to come with some tough choices, things like what to invest in now versus in the future, where to invest in adaptation versus retreat, how to integrate perspectives of all impacted parties in making adaptation decisions. And so from that standpoint, I would encourage everyone to not just think about the what of the adaptation toolkit, but also the how, and think about putting in place measures today to start to build an adaptation plan and an adaptation strategy, because implementing this will take time. And then finally, as our work has shown, the only way to reduce further buildup of risk is through decarbonization. Essentially, all of this risk that we've talked about is associated with warming, and therefore to manage the buildup of risk, we need to manage warming and manage that through reducing emissions going forward. This work has not focused on decarbonization. We're actually undertaking a second research effort now that is more squarely focused on decarbonization, but it is clear that the only way to reduce further buildup of risk is through decarbonization action. So with that, I wanted to leave with a couple of quick slides on COVID, especially since we've heard a few questions related to that. So Peter, if you move forward, or how about you move forward to, yeah, great. So we've recently released a piece of research that has looked at the intersection of climate and COVID, what the COVID crisis teaches us about climate and what we can do in the recovery to accelerate the climate agenda. And as we talked about a few times, there are certainly similarities between the current pandemic and climate change. They are both systemic, nonlinear types of risks that we're experiencing. They're both risks that we are more vulnerable to because we've optimized short-term performance over long-term resiliency. And the good news is that what the pandemic has done for us is emphasize the importance of resiliency. I think the concepts of risk and resiliency are much more now in the nomenclature of individuals, companies, countries, and all of that is a positive for climate action. But if we click again, Hauka, what we find is that this could mean both tailwinds that could accelerate climate action, but also possibly some headwinds. On the one hand, when we think about accelerated climate action, we've seen that behaviors can change very quickly. We started teleworking. We've seen a much more greater reliance on digital channels, all the way from online retail to telemedicine. There's a potential shortening of supply chains. I'm not sure that there's going to be reshoring, which I know a lot of people think might happen as a result of the COVID recovery. My own perspective is that we're probably going to see more regionalization of supply chains. But it is fair to say that supply chains are likely to shift in a way that may mean more short-haul versus long-haul trade. We're starting to see a better pricing and understanding of risk as a result of people thinking about COVID, and that, of course, can translate to climate risk. And we're seeing an environment where there is likely to be investment and stimulus in the recovery. And so all of that could help accelerate climate investment. On the other hand, there are things that could delay the energy transition, delay climate action. And that's everything from low prices for high carbon emitters to thinking about prioritizing other economic needs. I know there's a lot of conversation now about green versus brown stimulus. Questions about wealth that could cause delayed investments, delay of capital allocation to new lower carbon solutions. So I would say my perspective is that as with any crisis, as with any moment, as with any risk, there's both a risk as well as an opportunity. So it's about identifying the right synergies between a COVID recovery agenda and a climate agenda and using the moment where risk and resiliency are top of mind to drive action. And so with that, I think we'll leave up this slide that talks about how governments, companies, and individuals as well as civil society can use this moment of COVID recovery to think about the sustainability and the climate agenda, but maybe open up in the last 10 minutes or so for additional questions. Peter, over to you.
Yes, thank you, Mika. And thank you, Hauke. So we have quite a few questions coming in on a range of topics. You covered most of the COVID-related ones with these slides. There's one which is not COVID-related, and it's this, which is there any way to translate all of these physical risks to an overall cost estimate? For example, the decrease in GDP nationally and internationally, and how valid would a number like that actually be?
Yeah, maybe take that to make it a kind of can take a breather. So I think this is a compelling quest, right, to try and put out a big number of the aggregate impact of climate change. Based on what we learned in our work here, we are very cautious about such an endeavor, because I think what we learned is really that second and third order impacts and knock-on impacts are really quite important in this context. So it's quite feasible to estimate first order impacts, so the direct damages caused by climate change, but then there's the cascading impacts, which are also often nonlinear, and how risk then percolates and cascades through the system. Actually, a lot of the total damage accrues. And these things are almost by nature unknown in their full extent and unpredictable in their full extent. I think any global damage number will most likely be an underestimate, and many of the phenomena caused by climate risk are ultimately not really robustly predictable.
Yeah, and I can add to that. I think that's right. This speaks to the point we've now hammered home a few times about the non-linearities in these systems and how identifying those non-linearities, particularly when it comes to economic, financial, and social systems, is particularly challenging. Having said that, I think the approach that we're starting to see institutions take to integrate this thinking is very much a scenario-based approach, right? Doing a set of what-if analyses. What if insurance becomes unavailable in a particular geography? What if we start to see migration? What if we start to see conflict and unrest? And I think that is a much more rigorous path forward than trying to create a big number that is singular. I think there's so many uncertainties in this space. It's important to explore this in a truly scenario-based way.
Okay, there's another question that came in around different regional approaches that you've been taking with this research, and this one is specifically on Europe. There's somebody asking, could you please expand a little more on what the impact in the Mediterranean area could be? Drought seems to be quite a danger for Spain and southern France and Italy. Is that indeed the case?
Yeah, I think that's indeed the most pronounced physical change that scientists expect. So I think that the Mediterranean basin is one of the regions where you see the largest increase in drought. So it becomes warmer and drier. And that, of course, then has or could have a range of knock-on effects on business and society. I think the good news is, of course, that most of agriculture is comparatively well protected, since we have good penetration of irrigation systems. So that the immediate impact of drought is not as severe as it would be in other parts of the world, say in Africa, where rain-fed agriculture is still the norm. Nonetheless, there will be impacts. So even for agriculture, particularly very temperature-sensitive crops like grapes, like winemaking, could be impacted if the terroir of a certain region changes. There could be other impacts. For example, at some point, it is conceivable that it becomes just too hot to sit on the beach, and Mediterranean tourist destinations see a decrease in visitor numbers. There's also the possibility that we see wildfire risk increasing. So it's forecasted that the area at risk from wildfires in the Iberian Peninsula is going to double over the coming decades. So that definitely will be quite material impacts primarily driven by increases in drought. Of course, there are other changes too. Precipitation will become more extreme as we see stronger rain events interspersed with longer drought periods. Sea level rise and stronger storms are also affecting the coastal regions. But I think the leading or the most dramatic increase we see indeed in drought.
Yeah, thank you. And in fact, you can read in detail our findings on these issues, on the regional impact in the report. And if we go to the last slide, we'll see there's the link there for the climate risk report where you can read. We have one last question very quickly for you, Mikola, which is, don't you expect a strong rebound effect on climate post-COVID?
Yeah, that's a great question. I tend to be an optimist and see the glass half full. So yes, and I think for a few different reasons, right? One is what we've said already about the increased focus on risk and resiliency in a post-COVID world. I also feel like the COVID crisis has shown us how quickly change can happen on a few different dimensions. We've seen behavior shift. We've seen increased innovation in how public, private, third sector entities can work together. We've seen society mobilize at scale. And we've also seen increased appetite for stimulus and recovery. So I think all of this can help us think about climate action in the post-COVID world through COVID recovery. As I said earlier, there are, of course, also some headwinds. And of course, this deep question of focusing on an economic recovery. But I think it's important for everyone to not think about this as a trade-off between the climate agenda and the COVID recovery agenda and identify synergies between the two, because I think there are plenty of synergies between the two.
Okay, well, with that, I'd just like to thank you very much indeed, both of you, Hauke and Mika. And of course, thank you, everybody who's tuned into this webinar, for your time. This is the latest in our MGI Economic Impact Series. And I'd just like to say that the report is not just MGI, but it was done with McKinsey's sustainability practice and the risk practice. And so thank you very much. Enjoy the rest of the day. And before you log off, there will be a quick survey that pops up on your screen. If you could just reply to whether you thought this was useful, and we hope you did find it useful. And we look forward to seeing you again soon. Thank you so much.